Hi everyone, I'm Paul and welcome to my market update for the 13th of October 2022. Markets have been on a knife edge for the last few weeks and everyone was looking to the Fed to provide some kind of directional catalyst. Yesterday we had a release of the speech by the Vice Chair of the Fed on price stability, and we also had the September minutes from the FOMC meeting. There were no real surprises in either of these releases. The Fed's been super clear on its intention on bringing inflation back to its 2% objective and their commitment to reduce their balance sheet as they communicated originally in May. Risk markets seem to be finally getting the message that a Fed pivot is off the table for 2022 and probably deep into 2023 as well. The real question now is, will the cumulative effects of the Fed's policies lead to a recession in 2023 if we're not in one already, or what's called a hard landing? Personally, I think that we will, and I suspect we'll start to see the first insights of this ongoing recession, which is a natural result of demand destruction, showing up in company earnings, and if not in the earnings themselves, in the forecasts or the forward forecasts that companies are going to be giving in the upcoming reporting season. And so what does this mean for risk markets and for crypto in particular? Well, before we jump into today's video, make sure you like this video because that'll help other people to find it. And if you haven't already, make sure you subscribe to my channel and turn on notifications so that you never miss an update. Now let's jump into today's video and check out some charts. So we'll start today's video with the DXY, or the US dollar index. Now, I talk about the DXY in nearly every video that I do in my market updates, and for good reason, because it's pretty much the only show in town at the moment. And this is the monthly chart for the DXY, but it really illustrates just how strong the trend has been. And so you can see some of these initial marks that I made up on the chart. So my initial targets was this swing low here, that purple line. You can see we've very easily breached that. And there was this fair value gap just here that was sort of my initial target, sort of very early on in the rally when we were down around this $100 mark. We've easily breached those, and you can see we touched the top of that fair value gap before pulling back a little bit, but you can just see how strong this trend has been. Any pullbacks have just been bought and the market just continues to march higher. So my expectation now, given where we've come from and how we've traded up to this point, is that we're going to retest these highs back here, these relative equal highs. This seems like the most natural draw on liquidity now. And so I wouldn't be surprised if we get up to this, 120 level and then potentially consolidate around there. We need to see a bit more price action around this price point before we could project any further. But certainly just given the strength of this rally and just the backdrop of, all the macro that we've been talking about over the market updates to date, is that this seems like a likely target. And this really gives us, a good backdrop as we go and look now at the S&P and then onto Bitcoin after that. So we'll start by looking at the S&P 500 and we'll look at the monthly chart to start off with. Now, this will just give us a bit of a backdrop. We've obviously looked at the DXY and seen the strength of that rally, and equally you can see the strength of the fall that we've had on the S&P. Now, in previous videos, I've talked about where I think the most likely consolidation will be from here. And, we've got this pre-COVID high here, which, coincides with a lot of the support or, the demand zones, if you want to call it that I've been looking at. So we have this monthly order block here, and you can just see how the market's trended down and we're starting to come into this zone now. Now, the things we need to keep in mind is what we've already talked about in other previous updates. Behind the backdrop of the strength of the DXY is that we know that the Fed has a policy of keeping rates higher for longer. So they've learned from some of the previous policy mistakes of reversing too quickly, and they need to get inflation back to that 2% objective. So as market participants, we should be expecting that interest rates are going to be maybe higher than they are now, or even higher than have been projected, and that they'll stay there for longer until we get back to that 2% target that the Fed has set for itself. So as I mentioned earlier in the video, the place that I think we'll see interest rates start to bite is in company earnings. Now we'll start to see that demand destruction, maybe not necessarily in the Q3 earnings that will be coming out, quite shortly, but certainly in the forward forecasts and, some of the hiring and so on that we'll see coming out of companies and, the resulting change in innovation as a result of that change in the interest rate landscape. So based on that backdrop and just how hard and how quickly rates have been increased by the Fed, I think it's almost impossible that we now have a soft landing. And so we're going to have that hard landing or recession if we're not in one already into 2023. And so if we do have a recession, technically the kind of numbers that we talk about when we're talking about a recession is a 30% pullback from the high. So if we just sort of take a rough estimate, we take the high and drag that down, you can see we get pretty close to that top of the cycle high that we had pre-COVID. So that was when all of that stimulus started getting pumped into the market and we had that dramatic increase in the money supply. So you can see, 30% takes us a little bit lower than that, down to around 33.50. Now, interestingly, Jamie Dimon was interviewed today or yesterday, and he talked about the market going potentially 20% down from here. Now, that's a pretty extreme move, but he's the only remaining CEO from the GFC sitting at any of those big banks. So certainly he has a unique opinion on the markets, and to have someone like that talking about 20% down is something that I take notice of. So my investment hypothesis, if you like, has always been that once the Fed changed tactics and started tightening, is that they would need to remove all of the stimulus that they put into the market. So all of that increase in the money supply had to go somewhere. It went into risk assets, and so we effectively just have to chop the top off. So all of this, froth, if you like, has to come out of the market. And it's only once we get back to these, pre-COVID levels will the Fed have achieved its policy objective. Now, if we zoom into our daily chart on the S&P, you can see the market has been trading, really technically. So we had this big pullback, we came down, we took out all the sell side liquidity as we had that, typical sort of bear market rally. We've taken out the buy side liquidity, we hit these relative equal highs. It's been pretty much one-way traffic from there. You can see each fair value gap that formed, we've traded back into it, sold off, again traded back into it. With this one we actually came quite deep up and into this second one before we sold off again, and even some of these smaller ones that we've formed on the way down have been well respected. And you can just see the market has continuously attacked liquidity in both directions. And here we are now, we've taken out the lows from earlier in June, and we're now painting, relative equal lows down here again. And these look again at threat, and we're starting to come into these, demand zones that we talked about before. We have this order block on the monthly, and we have this, bullish fair value gap here on the daily chart, which also coincides with that pre-COVID high. So I think there's a lot of confluence around this, 3,400 level, and that's where I'd start to expect to see the market at least start to consolidate for a while. Not that there may not be more downside to come, but certainly that's one of the targets that I'm looking for, because I think that's the next most likely draw on liquidity. So we'll finish off today's video with crypto and looking specifically at Bitcoin. So one of the key things to remember about Bitcoin and just crypto in general is that they're highly correlated to the S&P or to the stock market. Now, there's lots of talks of the decoupling and all of that sort of thing, but the reality is the correlation is still there. And so we really need to be keeping an eye on the S&P, because that's going to give us, really clear direction on what's going to be happening in Bitcoin and just crypto more generally. So if we look at Bitcoin, we're looking at the monthly chart here. You can clearly see the pullback that we've had. It's been far steeper than what we've seen on the S&P. Obviously just reflects, the risk profile of Bitcoin versus the stock market. And the thing that should jump out straight away is that this all-time high that we had from the previous cycle high, which is about 19,800 has just been a really key level for Bitcoin. And if you draw it across, it's this purple line. You can just see, the market, once it broke through that, it really took off. And then on the way down, you can see, we've closed above it, or managed to stay closed above it all throughout this period in June. We may have wicked below, but we've always closed above. And so the key thing that's happened in the last 2 months is that we've actually closed below, and this, support, if you like, has now become resistance. And you can see the market closed below in September, and now this month we've traded up into it and then immediately retreated back. And so the next draw in liquidity that I see is these relative equal lows that we have down here, and this is obviously from the June low that we had this year, and this low on the candle here we had in December 2000. Now, I've talked about this in previous market updates. The area that I'm looking at, going and buying a lot more spot myself, is down here in this bullish fair value gap we have on the monthly, which is down around this sort of 12,000 mark. Now, that might seem a long way from where we are, but if you remember, most pullbacks in Bitcoin when we've had, a bear market have been about 85%. And if we go from, the peak that we had back at the end of last year, just to today's prices, we're not quite there yet. You can see we're down here at about sort of 74%. Now, that's obviously a really big retracement from the high, but it's not obviously 85%. If we go down to 85%, you can see, that takes us even past that 12,000 mark down to around about 10,000. So if we were to replicate previous bull markets, then we could see, even that $10,000 mark. So that's not something we necessarily will see, but it's certainly something to keep in mind and be prepared for. So with those levels in mind, let's zoom into our daily chart now and have a look. So if we focus on the last couple of months of trading, you can see we've been in this very tight range, right back from when we hit those June lows. Now, the thing to really focus on in this range is how it's consolidated and how it started to, contract over this period. So we've been trading pretty much level to level all the way through, which has been great for people who have been, trading that range, doing those sort of mean reversion type trades from one level to the other. So that's been obviously really successful for anyone following that strategy. But the thing that's happened over the last few months, sort of from about August, you can see here, we're only trading pretty much into the midpoint of the range. You can see we sort of deviated a little bit more here, then down to the bottom of the range and back up again. And so that's certainly a cause for concern, because whenever you get a decrease in volatility, especially when you have, a consolidation or a really large ranging environment, is you're going to get an explosive move in one direction or the other. Now, we see this kind of behavior in markets all the time. It's really common, and it's a really difficult scenario to trade because you will get a big increase in volatility, and if you're on the wrong side of that, then you'll just get really taken out. And so one of the questions is, well, how do you trade this kind of scenario? So the first thing that I would say for anyone who's a new trader or just not really confident in their view is that, if in doubt, you should just stay out. So don't go into the market if you're worried about this scenario. If you're in cash, you don't really have to worry, because if the market pulls back to a lower level, you obviously got an even better buying opportunity. If the market shoots upwards, which I think is probably the lower probability outcome in this particular scenario, well, then you've got better confirmation that we've had a market bottom and that you're still going to be getting in at a pretty good price, because anything around 20,000, really in Bitcoin for a long-term investor is still going to be, a great price, considering, you would think that we will take out those previous all-time highs at some point in the future. So that's sort of what I'd say for newer investors or anyone sitting in cash and not really sure what to do, is just stay out and just let the price action dictate what you do next. You really got, good buying opportunities or good places to purchase in the future. Now, if you're looking at trading this, my personal opinion, as you've seen throughout these videos, is that I think we're going to break down, we're going to get another leg lower, and that's going to be the opportunity to go in and start accumulating. And so it's a very clear, position is to be trading the base of the range and have your, risk management set appropriately, because if the market does explode, the other way, and it will really explode the other way, is that those stops will just get taken out really quickly. Obviously could be some slippage there, but that's why you have to manage your risk appropriately. The other possibility that we get is we do get a breakdown of the range, and so we do break the bottom of this range and do trade lower, and then potentially, reclaim straight away. Now that would be quite bullish, I would think, if we come back into this range. And if we did that, I'd suspect that we would then trade to the top of the range and then maybe higher. But as I said, personally, I don't think that that is a high probability either. I'd say that's probably a higher probability than a breakout to the upside. I think a fail of the range and then a reclaim would be much more likely as we see buyers start to step in at these value prices, sub 18,000 and start to accumulate. We could get a rapid, reaccumulation and then trade back into the range. But for my mind, just given the macro environment and just where we see the S&P and the Dixie, I think the Dixie is going to go higher. I think the S&P is going to go lower. And given the correlation between Bitcoin and those two assets, both positive and negatively correlated, I think we're going to see lower prices in Bitcoin. And for my mind, I think we're going to see the market come down to this sort of 12,000 mark, maybe not quite that low, maybe around 14. I think anywhere around there is going to be, really exceptional value. And that's where I'll be starting to, really seriously deploy some money and getting into spot. Thanks for watching my market update for the 13th of October, 2022. I hope you enjoyed today's video, and I hope that it helps you a little bit to navigate this pretty difficult time in markets. If you did, please give it a like to support this channel, and if you haven't already, make sure you subscribe to the channel to see more content like this one, and don't forget to turn on notifications so that you never miss an update. Thanks for watching, and I hope to see you next time.